Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
Welcome back, ladies and gentlemen, to the Family Banking Show. We're your hosts, Derek, Rob, and John. Guys, how are you this week?
Doing well, Derek. To talk about something other than weather, although weather is interesting lately because we just had our first snow on Halloween.
First snowfall.
Yeah. There's a quote I've been kind of dwelling on lately. It's about just that every day is a gift. And someone in a podcast shared it where, today, if you were given $10 million, would you be happy about that? Generally, most people are like, yeah, I'd be stoked.
Mm-hmm.
The same question then, but in a different light, if you were given the option for $10 million to have $10 million and this be your last day, or get zero and you continue to live on, what would you rather choose?
Zero.
That is hit home for me to understand that every day is a gift. It's worth far more than $10 million, obviously, to me at least. That no amount of dollars makes life any more valuable or any less valuable. So today's a gift. I'm just super thankful to be here and be here with y'all and just really enjoy what we do.
Yeah, great perspective, John. Thanks.
Well, I am going to still talk about the weather because like a week ago it was 70 degrees and now we have snow on the ground. So it's pretty crazy to think how quick the seasons change for us. But
it's my trigger. Once this first snowfall hits, then tomorrow I'm going to get the snowblower fired up for the first time just to get it running.
Make sure it still works.
Make sure, because you never know. Like this is something I've learned, is you want to make sure your snowblower is in good running order, because when that first snow comes that you need it and it doesn't start, that's a problem.
Yeah, I was thinking the exact same thing. Yeah, we went out to eat last night with the family, and both my wife and I just kind of grumbled, moping with the cloudy weather. We're just like, not ready for winter.
Yeah.
I saw a guy in flip-flops, shorts, and a polo. Snow.
Yeah. Yeah. Well, good. All right, guys. Well, this week we're switching gears again. We're going to talk about some basic components to whole life insurance for our listeners. Hopefully that they'll gain some value from this and we'll be able to share it with friends and family and colleagues. Guys, why don't you go ahead and start us off about the topic of what is base whole life insurance and how is it different to the paid up additions component of an infinite banking style policy. So John, why don't you kick us off? Tell us a little bit about what is base whole life insurance, why is it important, and help the listeners to try to understand, is it something that we should emphasize, or how much stock should we put into the base component?
Sure. So yeah, obviously we are talking about whole life insurance, which is a key component to the infinite banking concept. We believe it's the most efficient tool to control and create your own banking system. And so we have found that many people we get to talk to on a daily basis have these kind of nuts and bolts questions of the mechanics of whole life insurance. And so we are so glad to be able to provide this as just a reference and a resource to understand a little bit, more in depth what goes into building, designing a policy for the goals at hand, particularly for infinite banking. And so I'll start with the base, as Derek just talked about. That is historically, traditionally, all we know whole life insurance to involve, right? It's just a premium. It's a type of premium that is expected to be paid out for X number of years. Generally, it's for the majority of your life, up to you can pay it up to age 100 in most cases. And that base premium, we like to refer to it as like the engine or the chassis or it is the substantial meat of the policy. And what it does is primarily, especially in the upfront years, purchase death benefit, right? So we understand it to be something that gives you the death benefit, but also is something that you can pay and you have the opportunity to pay, right? We treat premiums as a deposit into our bank, not necessarily as a bill. So
Right.
you have the opportunity to pay this base premium portion of the whole life policy for a very, very long time. And for most people, that's a very good thing, because generally, if you're just working, say you're in your 20s, 30s, your income is going to increase over time, and you want to still have that ability to store your capital in an advantageous vehicle. So base premium proportionately will purchase far more death benefit than any other types of premium in a whole life context. A trade-off or a lever that is, kind of pulled, that, there are no deals in life insurance. You'll hear us say that often, that it does not give you immediate access to the full amount of cash in the form of cash value, as perhaps other types of premium would, right? So it's that long-term play. It pays for the death benefit, for the the kind of the operating costs involved with life insurance, and is definitely a key component of building these policies, so that we keep all the tax advantages, we keep the legacy piece, in play, and also just give you that option and opportunity to store your capital in the best place possible.
Yep. Thanks, John. So that's like John's saying, the chassis, the base component of whole life is that base portion. But then one of the options you have, whole life policies have what are called riders. And these are things you can add on to a policy, such as a waiver of premium rider, accidental death benefit riders, different riders that you can add to policies, just like you can add riders to policies on car insurance, for example. But one of the riders you can add to whole life it's called paid up additions rider. It's the option to buy fully paid up pieces of death benefit. And death benefit, whether it's a paid up additions portion or a base portion, whenever it gets paid up, it has a cash value, an immediate cash value to the insurance company. And so you have your base, which is your long-term portion that's growing over time and purchasing death benefit as you go. If you then put in a rider called paid up additions, and that's what that combination of base plus paid up additions, that's what you would call an infinite banking style policy. That gives you that immediate cash value that you can leverage. So it's a combination. You have base plus you add the paid up additions portion. They're fully paid up units of death benefits, so they have immediate cash value. That cash value then is in your policy, available to you to leverage against immediately for big purchases, emergencies, investments, that kind of thing. So that's the paid up portion of the two components.
Okay. And guys, remind our listeners, is this something that every insurance agent would be capable of designing or skilled at designing? Or is this something that's more specific to, there's a few set of advisors that are really excellent at doing these types of policies for their clients?
All three of us went through the Nelson Nash Institute Infinite Banking Concept Practitioner Program. And I think that's absolutely, if it's us or anybody else that you're looking to work with, a key component to understand and check that box prior to moving forward with the policy. Because we've gone through hours and hours of training, even mentorship with people who've been doing it a lot longer, to understand exactly how these policies can benefit ultimately the client. That's what we're here for, is to serve as many people as possible to reach their goals, become their own bank, recapture all that interest that they're losing to the outside banks. And so we've been trained to understand the ratios and different people's goals with how we would design those policies and the different trade-offs involved. So most agents, they don't even consider putting a PUA rider on these policies from what I've experienced and seen from talking to different people. So it's not a very common thing to see just a standard life insurance agent design these policies in this way. I don't know, Rob, have you seen anything different?
No, you're right. Like that, it's not common. Typically, whole life insurance agents, they just sell whole life straight, just death benefit whole life. They're not aware of even that you can add this paid up additions rider that can give their clients the best of both worlds. You get death benefit coverage and you get immediate cash value. And so that, yeah, and you're right, John, going through the practitioners program, we got trained in how to do that correctly, what it is, how it, what goes on behind the scenes in terms of how you create them and what the components are, the insurance components are that allow that to happen. And then again, it's just what's best for the client. So the thing with an infinite banking style policy is if you reduce the base to give yourself room for more paid up additions, you are reducing the amount of death benefit coverage you have. So you have to understand, like, when you talk to your client, is their main goal more death benefit or less cash value, or do they want roughly the same? Like there's no deals in life insurance, there's just trade-offs. So you talk to your client and you kind of figure out where they want. If they're focusing on death benefit and they also want cash value, then we design it a certain way. If they want more cash value and less death benefit, we design it in a different way. Another thing too to be aware of is you can have both, because what we've done often is you can have a infinite banking style policy that is emphasizing the paid up additions rider portion and giving you more immediate cash value, but your death benefit protection isn't protecting your family in the way that you would like or the way that you think is best for protecting your family. We can add a convertible term rider on the side that's a low cost, but it covers you from a protection standpoint. So you'd have a infinite banking style whole life policy, and then on the side you also have a convertible term policy that protects your family. But then the other cool thing about a convertible term policy is, let's say it's $1 million convertible term. That's $1 million of death benefit that are locked in at your rating. When you have to apply for life insurance. It's the only product out there that you have to get approved for. So you apply for life insurance, and then you are rated due to your health and your age and mortality tables. You get a rating, and then let's say you're super preferred. Let's say, well, if you at the same time you get your infinite banking style whole life policy at super preferred, you also then get a convertible term policy on the side at super preferred. That's locked in. So now you have $1 million of potential death benefit that you can convert in pieces as needed, in chunks. So let's say a couple of years go by, you have some more income, you want to add another policy. If your health changes since then, you don't have to worry about it, because you have that locked in $1 million pool of convertible death benefit that you can take let's say $250,000 out of, convert that into a whole life policy, $250,000 whole life policy, and you still have the $750,000 policy left now remaining that continues on, that you can keep converting out of. So it's a great way to have the best of both worlds. You have the immediate protection of your whole life policy, where you have the base plus the paid up additions, which gives you that cash value that you can leverage for life and emergencies and opportunities. That's continually growing, guaranteed. Then on the side, you have your convertible term policy that you can always draw from at the same rating, that you can continue to add more policies on as needed going forward. So it's a good combination.
And as our listeners and our clients trust us to be, skilled at this and designing a policy that's going to meet their needs, whether it be, slightly higher cash value in the early years or long-term protection, what's the one factor, no matter what, that we are always trying to avoid?
negative tax implications, I'd say. And that's in the form of what's called a modified endowment contract, or MEC, as you'll probably hear us say. That essentially, if it does become a MEC, which means, simply put, the proportion of premium paid in relation to total death benefit, if it's far outbalanced, where you have too much premium in and too little death benefit, then the IRS is going to treat this policy like an investment rather than just a plain life insurance policy. After that, once a MEC, always a MEC, where you are going to have negative tax implications from there on out, where you're going to have, penalties to access it. It's almost like a retirement account where we don't want it.
Mhm.
We don't want to segregate our money or put our money in prison for a very long time, right? It'll then say until you're 59 and a half, you can't access it unless there's a penalty. It's first in, first out tax treatment, where immediately anything that you use, they will take from the gains first as taxable income, and then your cost basis, unlike the reverse where you can access it all tax-free. So we are very careful. We borderline obsess over designing these policies to make sure they do not become a MEC, right? Our policies are not ever going to become a MEC as well. So we definitely practice what we preach in that regard as well. So, and another thing I'll say is there's no one size fits all to this. Like, we are not the guys with hammers and everything's a nail. We believe that every single person has their own unique goals, present position, and what their financial picture does look like. And we can design exactly to where, to meet them where they want to go.
Yep.
And in some cases, that could be all base, no PUA, and that's totally okay. In other cases, it could be a smaller base. In other cases, it could be just a blend and convertible term like Rob talked about. That's the beauty in the expertise that we bring, I believe, is that it's kind of an art in addition to the science of the math behind everything, where we just give people what they want, right? We give them the legacy, we give them the banking function, we give them everything, to the best of our ability within what's available. So that's the fun part for us, that we kind of get to nerd out more and more about every day.
Awesome, guys. Well, any other thoughts when we're talking about kind of just these basic components to whole life insurance that you think would be valuable for the listeners?
I'd maybe just add that, that's, keep the questions coming. We'll, as we encounter clients, so for example, one of my clients that had a question about convertible term. They thought that their convertible, they had $1 million convertible term, and they thought that when they converted that, let's say a couple of years from now, that they'd have to convert the whole entire $1 million of convertible term into $1 million whole life policy. And so that was just an education kind of moment for me, where I said, no, you don't have to, you can convert whatever portions of that you want. It's not all or nothing. So in 2 years, if you want to take $250,000 out and start a $250,000 base policy that we can then, design for you, then you can take $250 out and you still have $750 left. So those kind of questions that our clients are having, that's what this series is about. We're just going to try to put forth the questions that our clients have and then talk through them just to educate our listeners and answer any questions that they might have. So looking forward to kind of this fundamentals of IBC, or whatever we're calling it, kind of going through that process.
Sounds good. And if our listeners are interested in connecting with us and working with us, you can reach us at thefamilybankingshow@gmail.com, and we'd be happy to sit down and work with you and your family. All right, guys. Well, thanks again. We'll see you in the next episode.
Sounds good. See you guys.
Thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.